Hello everyone, welcome back to the Velocity channel where this is your bridge to financial freedom. I feel like this example is actually going to be a staple so that you know how to tackle any loan that you come across. Now you know the science behind velocity banking and why we do not segregate our income as much as we do when we were under the TB, right? Remember, TB is a disease, right? It's called traditional banking. We don't want to do that. What we want to do is we want to make sure that we're utilizing anything that we have, be it a line of credit, checking, or a savings account to our advantage versus the banks. And I'm going to show you how to knock this out with not just a small line of credit, but also a larger one. What does that look like when we're using our finances a different way other than the way we've been taught, okay? So before we get into that, let's go ahead and like, share, and subscribe so that everyone around the world can know the power of velocity banking. Folks, you're still going to be out of this within the 8 years, and that's exciting, okay? Even with a $900 credit limit, right, and $150 cash flow. Do you understand that people that have way more cash flow and way more lines of credit are still going to be paying way more than you are in interest, right? They're going to be paying way more than $80,000 in interest with this, all of this. I mean, look at the percentage rates, okay? Well, you're going to be paying $49,000 in interest with the $150 in cash flow and the $900. Now, let's go ahead and change it up, okay? We're done with that. Let's change it up, and let's say we were able to, within a year, right, or two, increase that to $9,000, and, oh, by the way, we've got to increase our cash flow as well. What is that going to look like for us? Okay, so now we're talking about getting rid of all of our loans at a faster rate. Do you remember the relationship that the lines of credit have with the loans? Now, with the loans, you can always remember loans like this. And there's a reason why they say that this is an amortized payment. It doesn't matter how much, as you've seen, that you pay towards the principal, you're still going to have that regular payment. That's why they call it amortized. As a matter of fact, if you take the word amortized, okay, you'll find that there's death right in the middle of it, and that's the word mort, or to kill. And the reason why, right, it's called amortized is because they're letting you know what they're doing to your pocketbook, and they are killing it. Look this up. I'm serious. It's mort in Latin, right? Death in English. Now, what we want to do is we want to not kill our bank account, but kill these loans. So let's amortize these loans. Let's amortize these loans. It's time to do it. So let's take our $9,000 and let's go ahead and apply it to the principal on the most cash flow sucking loan, our auto loan. So let's make sure that this $28,000 goes down to about $19,000, right? Right. Now, what happens when we have the $19,004 instead of the $28,000? What happens to that payment? How is it allocated? You want to know how that's allocated? Okay, let me show you. So before we go any further, we just want you to know that, Jay, if these numbers is what the lender gave to you, I want to let you know that some of these loans are not right. They're not right. I didn't say that on the other video, so just let me make it clear to you. Some of these lenders are not telling you that you are only paying about $1.22 to the principal in some of these loans. I know some are like that. Most are great, okay? But please, perhaps you misread something or something like that. I'm not blaming the lender. I'm not blaming you. I'm just making an observation. There's no way that this number is correct. And there's no way that this number is correct as well, okay? You would need to pay more than the $150, at least $250, because it's at the 15%. And here, you're talking about paying for over 360 months. So I don't know if you read the paperwork wrong, but please watch out for that though, okay? Because there are loans like this where the person never pays it off, okay? So please watch out for that. Make sure that you're paying the correct one. Go through that paperwork. Let's do the calculations. That's why I say this Tuesday is the webinar. We can answer your questions there about that. We want you to know what's going on with the finances. So let's go ahead and continue on here. We're making sure that this is knocked all the way out. The 20%, the $403, man, they have you paying about $1, if that, towards the principal. The rest of it is actually going all to them. We don't want that happening, right? We want to make sure that we're paying more towards us than them. So that's why we went ahead and we deployed the $9,000 towards that principal so that more can go towards the principal versus towards the interest. Now that payment is still going to be split up, but it's not going to be as bad as it was. So let's say, before it was $1 to principal, right? Now it's going to be like maybe 20 or 30 or maybe $50 towards the principal, okay? And that's why I say there's no way that this loan is correct, okay? Not with the 20%. Now, $19,004, it doesn't matter though, because we're hammering. This is powerful. It doesn't matter if a lender tries to trick you like this, okay? Because we're hammering away at the principal, therefore we're hammering away at the interest. So they're only gonna get so much from us. Does that make sense? All right, so we have $9,000 deployed. How long until we can deploy another $9,000? Because it's all about R&D, folks. It's all about R&D. It's all about replenishing and deploying. So when are we going to replenish our $9,000? Let's go ahead and take a look here. What's 90 divided by 15? Huh? 6? Is that 6? Right here? 6. And then we have, let's go ahead and do the multiplication. 0, 3, right? Is that 9? 90. Yeah, it's 90. So it's going to take us still about 6 months to replenish. However, it's a whole lot more going to that principal now, not the 900, but the 9,000. So let's do this, okay? After the 6 months, we've replenished the 9,000. Can we go ahead and do it again? Let's do it again. So a minus 9,000, okay? That's going to equal $10,004, okay? Do we see how we're taking out the loans? And now we're at the what, 12-month mark? So this is month 12, and we've already reduced this headache of a debt so much, right, by $18,000. So now we're at $10,004, right? Then after another 6 months, okay, we're going to reduce it another 9,000. Remember, that's how long it takes us to replenish that $9,000. So let's go ahead and do this. 1,004. And of course, that's after the 6 months, so that's 18 months total. You just got out of this loan in 18 months. Does that make sense? Okay, let's go ahead and just have you take a look at that. Okay, much quicker than the 8 years. But do you see how that it's the cash flow that makes the difference? When you're cash flowing, you increase your cash flow, you'll actually increase your debt pay down. That's the relationship there. So now, of course, we'll just go to the next one and then to the next one and the next one. With this one right here, you can actually ask, hey man, can I have a lower, right, either payment? Can we reduce that interest rate? Can we restructure it somehow so that I have more in cash flow? Why? Because 84, it's not exactly free, right? But it is something that you can restructure, right? You can restructure. It's between the 51 and 99 mark. meaning you can do some restructuring there. You can ask for another interest rate. You can do a number of things to have the bank help you out with the cash flow, okay? Refinance, whatever it is you need to do, all right? Remember, we're not against refinancing, right? We're against ignorantly refinancing, right? Because some people just save $200 each month when they could be implementing the velocity banking on top of that refinance and just get completely out of their home and turn their home into a bank. So with this, we did the 9,000, right? And then we waited the 6 months. We did another 9,000. That's 12, right? And then 10,004 minus 9,000. That's 6. And 1,004. That's a total of 18 months, give or take. Now remember, this whole time you're going to be paying the monthly payment, so let's not forget about that, okay? But that's how it works with an increased line of credit. Jay, I think you can do it within a year or two. I think you're going to increase that line of credit. I think you're worth it, and I believe in you, all right? Let's go ahead and hit up that Tuesday night webinar that we have, so that, and the link is actually in the description below. Go ahead and sign up for that. We'll actually see you there, and if you have any questions, don't hesitate. Let's go ahead and ask them there, okay? God bless. You guys have a great one, and we will see you in the next video.